This is probably one of the most irrational market environments I think I've ever stumbled my way through. And unlike previous times where I have my planning off on the market, it seems like everyone has their market planning off. Whether I'm talking to someone who's running a hedge fund, who's not trading at all in the market, they're sitting on cash, or I'm talking to other traders who are, just as talented as me. And they're like, oh, I actually haven't touched a trade in like 3 weeks, or I'm just playing lightly. You get the point. It's a rough market environment right now. But the age-old wisdom that I usually lean on is that the market can be irrational longer than you can be solvent. So I don't want to look like an idiot holding positions that aren't working, hoping that eventually what I'm looking for will play out, especially when it comes to options. Now, maybe you have a stock position and you got a 10-year time frame, you'll be fine. But if you're holding an option contract and you only have a month, that beta and volatility will bleed the premium out of the contract. And even when it starts going into your favor, you might ever get that money back. So it's very important that as an options trader, which was mostly what I do, that I have the patience to say, I need to wait for my moment. I need to wait so my convictions can actually be there. Because if I just sit here on a wing and a prayer, even when I get what I want, it might not be enough. So what do you do when you're trying desperately to be patient, but you constantly keep experiencing FOMO and you want to hit the button to trade? You do research. So let's dive into what's been going on with the Fed minutes that just came out and some of the economic data that's also come out, but also looking to tomorrow, because I think it's really important that we talk about the future data as well. Now, despite what the market's been signaling, which is basically something to the fact of a recession's already occurred and everything's fine now, we're recovering, the Fed's base case has and is that there will be a recession later this year. And if we look at the Fed minutes that they just put out yesterday, I think it's important to note here that they say that if financial conditions lead to this mild recession, it could rapidly become more severe. I think it's really important because in my base case, Silicon Valley was not a one-off issue. And I know lots of people are saying, well, everything is obviously fine now. But we heard the same thing back in 2008. But there was a 6-month period before we started seeing signs of issues and the actual collapse. So remember that the time frame here for this being a severe issue could be, pretty large. So I think it's important to be patient and to also look at some of these hints and some of these red flags that are popping up. Because what happened here in the US could easily happen in other countries where they've also done some tightening, or they're also making some pretty dramatic changes in their financial policies that could cause some disruption within their financial sectors. So to say that it's just a one-off with Silicon Valley Bank or some of these smaller other regional banks, or to say that the Fed has just magically solved the problem because they've given out these extended loans, which is important to note that that's not the same as quantitative easing, is not the same as money printing. These are loans that are fully intended to be paid back. Now, they might pull up in the short term as showing up as a surplus, but that's not the same thing. I think it's really important that to not get that confused. In short, the point is, I don't believe them when they say everything's fine. And I'm looking at this saying, yeah, that does look like one of the potentials. And even if it's not one of the potentials, if you keep interest rates high while the economy is headed into a recession that you even recognize as your base case, yeah, I think it is pretty likely it goes from mild to severe. And to keep track of that, you have to look at the economic data and see what it's telling you. Earlier this week, we saw lots of confusion when the CPI print came out as a positive, or what people took as a positive because it showed inflation was coming down. And yet the market, on an initial rally, still sold off again. And then today, we had the PPI data, which has come down precipitously. Again, the market seems relatively stagnant and doesn't seem to know how to take it. Now, it's important to actually look at what prices are coming down. Because you might say, well, if these come down, that's a good thing because inflation's coming down. But another reason that a lot of these could come down is because of a lack of demand, which is more of a symptom of how the economy is doing. And I think when we actually look at what's coming down in the PPI price, if we're on trading economics, we could simply just click on this and just get, a nice little summary right here. 2/3 of the decline could be attributed to a 1% decrease in prices for final demand goods, namely gasoline. That's not good. If you see energy prices coming down, it means there's likely less production, less usage, less traveling. Everything. Services. So we're also seeing that services edged 0.3% lower, largest decline since April of 2020, mainly due to a 7.3% drop in margins for machinery and vehicle wholesaling. These this is writing on the wall. This is what you would see for a recession, is these types of symptoms pulling up. And so then I want to start looking at what data is coming up. And I'm looking tomorrow, 2 hours before the market opens, we have our retail sales data coming out. And I think the big thing here is that if we see this starting to come down, it's going to play more into that recession conversation rather than just this, oh, inflation's coming down, that's a good thing, because then the Fed could pivot. Okay, I think what we could end up seeing happen is that a Fed pivot is occurring because of how bad the economy is actually doing. And on top of that, we've heard them say that their base case is a recession and they still have no intentions to pivot. Instead, they want to maintain high interest rates. If you take them at their word, which so far to date is what you should do because they've stuck to their word. If they take them at their word that they're going to keep interest rates high and you're expecting a recession, that's likely to go from mild to severe. And I think we could be seeing that starting to play out if we see that these retail sales numbers start to turn over as well. Because then we're getting data that not only says that, hey, prices are coming down, but data that actually directly points to demand has been falling. The consumer is not doing so well. Now, despite all of that, earnings season is right around the corner. And it's important to remember that also tomorrow we're going to be getting our banking earnings. Now, the Discord seems a bit torn. Some of the traders in the Discord think that the banks have pretty much priced in anything that you're going to hear in the earnings call. And a lot of these people also think that there's no other major concerns in the banking sector. Now, I am opposed to this. I don't think that there's really any indication that everything has been priced in when it comes to what could hurt the banks, especially when you start looking at the commercial side of things, as in commercial real estate. I think a lot of people are forgetting about this side of the conversation where these companies are cutting jobs, they're cutting costs, and they're staring at these giant empty offices that they're renting. Yeah, I think a lot of those are going to be cut too. And that is also going to cut into some of these bank earnings. Never mind the huge, splinter in the eye of these banks. It should be the fact that the government is definitely going to have more regulation on them, especially when it comes to the smaller regional banks. I think that is a clear path that's going to be coming around, and that could even hurt the profitability of the larger banks. It's yet to be seen. And I think that's what prevented a lot of these stocks from bouncing back, because some of them I think have been sold off more than they should be. For instance, Charles Schwab, who took over TD Ameritrade, I think it's a very solid bank, but when you look at the price, the market doesn't seem to think so at all. And I think regulation is a big key to why that hasn't bounced back yet. Now, if we're looking ahead past the banking reports tomorrow, I think we have a very weak overall earnings season coming up. And I think that this could lead to the future declines that I'm expecting in the market. Another thing that we also have to keep in track of is the lack of volatility in equities right now. That's your stocks, right? Equity, stocks, same thing, right? So if I look at the VIX index over here, I can see that this looks like it's near all-time lows. It's continuing to melt down as the SPY melts up, right? But if I look at the MOVE index, which is the volatility in the bond market, we can see it's still relatively high. Now, what do we historically see? We historically see that VIX catches up with MOVE. Okay, so this is likely to catch up with the historically high volatility in the bond market, not the opposite, right? Equities tend to follow bonds. And so if I'm looking at SPY right now and I'm seeing, well, this is kind of melting up, but I'm expecting we could see bad data tomorrow that could bring that down, which would actually make this a top right here, which is nice little double top around the 413.75 area. That could be the top. If that data isn't bad tomorrow, we could see this once again. Like if we look at the 30-minute TTM squeeze, we could see that it's running pretty hot, running pretty positive. We could see this push to 420, that being the top, and then we come into a week earnings season where a lot of that starts to roll over. Either way that plays out, I'm, with monthly contracts holding very small positions to be short when they've been bleeding against me. I've taken some pain for holding those positions, but I'm still sitting on a ton of cash. Well, I have these small positions that are bleeding on me, but I still have a ton of cash, and I'm ready to chase the market to the downside. Because the way I look at this, I've had some people argue with me saying that my bearish stance isn't correct. Fine. You know what? I can chase a market. All right? I can chase a market. I'd rather be a bystander that has to chase a market than a victim. All right. And at the end of the day, that's what I'm seeing. And the one thing that I want to add, because I get this a lot, like a lot. And it's like your typical Redditor will say something like, well, if you're bearish on the market, then you're just too negative for me and I don't want to listen to you. That is stupid. That is so idiotically stupid and like triggering for me, because it is just an emotional, childlike understanding of the way things work. If you want a forest to bloom and blossom, sometimes that requires a wildfire to recycle all the nutrients back into the system, right? A market sell-off doesn't mean that I want the US to burn, or I hate this, something that's going on and I'm just being negative. This is actually me hoping that we get a real prosperity coming around through a sell-off where we can then buy the dip and then make an absolute killing. That is the positive outlook. The negative outlook is that this market continues to be a stagnant cesspool of nonsense that's difficult to trade. That's the negative attitude, where I know you don't want to ever see anything retrace whatsoever, and it should just always slowly crank up to the green for you. Whatever. That is stupid. It's just straight up stupid. And I should probably be a little bit more tender and understanding. Like, I understand you're new, but no, it's just stupid. All right, stop being stupid. Okay, let's be positive about this. But I'm only going to be positive about making money, not positive about the trajectory of the market. I'm going to be realistic there because I have to be realistic to make money. Okay, yeah, makes sense. Okay, makes sense. Makes money. Easy as that. Nice little rant to end the weekly report, man. As always, I will see you next week.